Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Nicholas Ong, investment analyst from Phillip Securities Research. Today I'm going to share with you the CPO price outlook and Q3 results season takeaway for commodities sectors under our coverage. Let us begin with the commodities sector, in particular the CPO outlook. CPO price has been trading range-bound for 2013 between $700 to $820 per metric ton. Year-to-date average price is about $760, down 23% year-on-year. This is one of the main reasons why we see industry-wide year-on-year earnings decrease in CPO companies. Malaysia CPO exports remain robust in October, up 3% month-on-month on higher demand from Pakistan and China. Cargo surveyor Intertek recently reported a 0.1% month-on-month drop in export for first 25 days in November, indicating that demand remains fairly stable for November. Malaysia's CPO inventory continued to rise from the 7th consecutive month to 1.8 million tons, up 4% month-on-month. That said, stock level has remained below the 2 million tons level for the 7th consecutive month, which we believe has resulted in the recent rally in CPO prices. We expect stock level to climb in November, as production typically peaks in October-November period, before easing in the first half of next year. On the supply side of the equation, Malaysia's CPO production was up 3% month-on-month in October. Year-to-October production is also up by 4% year-on-year, indicating that biological impact on Malaysia's plantation estates, though to a lesser degree as compared to its Indonesian counterparts. For Indonesia, CPO production continued to be weak in Q3, no thanks to palm trees' biological trend from bumper harvest last year. According to USDA, global CPO production is expected to grow by only 4.7% for 2013-14 marketing year, which is lower than the growth in previous 3 years. We see the supply tightness as a positive for CPO prices. However, things are not as bright in the substitute side of the equation. Based on USDA projections in November, we estimate that the stock usage ratio of global oilseeds in 2013-14 is 13% versus 12.1% the previous year. Recent news on weather improvement in South America seems to boost the supply prospect for soybeans in Brazil, the world's largest producer of soybeans. In addition, with EU imposing biodiesel anti-dumping duties on imports from Indonesia, this will, nonetheless, dampen CPO demand outlook given that about 90% of Indonesia's total biodiesel export in 2012 went to EU. That said, there is potential upside in CPO demand coming from domestic consumption if Indonesia could smoothly implement the B10 biodiesel mandate on time. Another area of concern is the narrowing price discount gap between CPO and soybean oil, which is now only at about $90 as compared to the long-term average level of $200 per metric ton. This indicates that substitution from soybean oil to CPO is no longer a catalyst for CPO demand. In conclusion, while Malaysia's low inventory level and Indonesia's weak CPO output have been supportive to the recent CPO price rally, we believe further upside could be limited in the near term on softer demand during winter season, anticipated higher supply of global oilseeds, and narrowing discount gap between CPO and soybean oil. Now let's take a look at the commodity counters under our coverage. Gold and Agri reported weaker than expected Q3 results, no thanks to weaker CPO prices, low FFB output, and high inventory levels. Management expects inventory level to come down in Q4, cost of production to remain flattish in FY14, and FFB output to recover back to 5-10% growth on reversal of trade stress. We trim our FY13 earnings estimates by 19%, mainly on the higher operating cost assumptions to reflect weaker Q3 results, but leave our FY15 and 14 estimates intact. Our target price remains at 50 cents. We see gold and agri as a good proxy to the CPO price play, since more than 90% of its earnings comes from its upstream plantations. However, given our muted outlook on CPO price, we maintain neutral rating on gold and agri. For Wilmar, the group announced better than expected Q3 results driven by higher oilseeds and consumer product margins, as well as turnaround in sugar. Palm and laurix remain steady with robust margin and volume despite new refining capacities in Indonesia. Wilmar remains our top pick within the commodities sector for three main reasons. One, huge exposure to growing markets like China, India, and Southeast Asia. Two, resilient vertically integrated business model. And three, it is a good proxy for the growing food demand in Asia. Our target price for Wilmar is $3.88. Look forward to Friday's topic on ABC of European economic reform, austerity, easing, banking reform, and cheap loans with investment analyst Ling Xing. We want to hear from you. Any questions, any comments on Friday's topic, please drop them via Facebook and Twitter. That's all we have for you today. Do stay tuned to next week's video. Thank you.